Welcome to our latest quarterly update. Once again, I'm joined by Gregor Hirt, our global CIO of Multi Asset, who will provide us a look back at recent months, as well as some thoughts on what the coming quarter will bring, and the implications that this will have for portfolio positioning. Hi, Greg, welcome.
Well, it's my pleasure being here.
So, looking back at the past few months, what have been the key developments?
We started the year on a positive tone with strong rallies in January for both equities and fixed income, which were supported by investors redeploying cash, solid economic numbers, weakening headline inflation rates, and of course the risk of an energy crisis in Europe that was abating thanks to the warm weather. However, already in February, markets moved to a more muted environment in terms of overall performance. And I think the key reason certainly was the persistency of core inflation, a problem Allianz GI highlighted repeatedly in the past, which led investors to refocus on the risk of tightening central bank policies. And indeed, central banks have acknowledged that more rate rises than originally thought would be necessary. Now, while fixed income has led this correction, as it is more sensitive to interest rates move, equity returns exhibited a much more mixed picture, actually. A bit more positive for the EU and Japan and more negative for the US. But of course, the most recent news is dominated by stress in the banking sector, especially for US regional banks and those specialized on Silicon Valley. So, what is our view in this regard? While these events have indeed the potential to cause instability in the banking system, the Fed's pretty prompt reaction has at least eliminated a layer of systemic risk, while larger US banks, which are broadly diversified, might actually profit from the situation as deposits will flow to them. Now in Europe, while bank-specific risk cannot be excluded, as we can see in the current case of Credit Suisse, the overall situation of the sector looks much more stable than in the US, especially thanks to stricter regulation in place after 2008. All market participants should therefore continue to focus on solid bottom-up analysis and favor liquidity-rich companies for the time being.
Thank you, Greg. So, what is your outlook then for the coming quarter?
Well, it is going to be an interesting quarter to say the least. On the one hand, central banks need to continue their restrictive paths, and more so than many investors are expecting. That is clearly negative for risky assets and bonds. On the other hand, they could be tempted to adopt a more cautious stance, especially the Fed, considering the risk of contagion after the recent banking blow-ups. After all, financial stability is also part of their obligations. Now, for equities, this environment could therefore be more volatile than in recent months, which explains why we have reduced US and global equities to a more negative stance beginning of March. We're a bit more constructive in some areas, not a lot. For instance, emerging market equities that offer attractive valuation and are supported by the reopening of China. Now, the latter will boost the demand for oil and copper also, which supports our more constructive tactical stance on the commodity complex. In terms of currencies, we remain quite cautious on the US dollar-euro as the ECB has to play catch-up with the Fed. But, cautious is also necessary here. As we know, in sharp correction, the greenback acts as a safe haven, so that our positions are smaller than compared to a few months ago. Looking at Japan, we have seen quite some Japanese yen volatility, and actually we expect the Bank of Japan to review its yield curve controls this summer, after the taking over by a new central bank president.
So given these developments and your outlook for markets, how are you currently positioned in your portfolios? Or to put the question differently, in the current market situation, where do you see opportunities for an active asset manager?
Well, a very good question indeed, thank you. The current non-trending and volatile market environment lends itself not only well to bottom-up selectors on the equity and fixed income side, but also for active allocators like us focusing on very specific trade ideas, sometimes relative one, that can generate additional outperformance actually. So currently, for example, we favor non-US equity exposures over US equities, as we see high valuation in the US, while the structural advantage of investing in US equities has recently vanished. Another idea is to replace German government bond exposures with Australian one, given the advanced tightening cycle of the Reserve Bank of Australia and also a steeper yield curve. And Finally, in emerging markets, we adopt a cautious stance on India versus the rest of the complex due to high valuations and political questions. Now, with regard to our broad proposal and the positioning that we have, unsurprisingly, we remain cautious toward fixed income exposure across the board, while from a fundamental point of view, we are now tactical neutral on US Treasuries. On the contrary, we are particularly defensive with respect to European bonds due to the ECB recent hawkish statements and the expected outlook also for rates. In terms of equities, we are negative for US and global equities, our preferred relative pick being emerging market equities, which benefits from both attractive valuation and China reopening. Structural problems in the UK, including both poor growth and high budget and current account deficits, have led us to downgrade the GBP versus the US dollar. And finally, in terms of commodity, we maintain quite a constructive view on copper as inventories are low, and especially with regard now to the future demand that is coming from China also.
Thank you, Greg. Your thoughts have been informative and fascinating as usual. So I personally look very much forward to seeing you again next quarter for our next quarterly update, and I hope to welcome all of you as well. Thank you very much.
Well, thanks a lot, actually, and see you then next quarter.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。